The impact of the COVID-19 pandemic on global yields. A short review of the 2020-2021 period monetary and fiscal policy responses. Expansionary monetary policies, along with economic recovery programs following the COVID-19 pandemic, have helped keep yields low and negative, especially in the European fixed income market, which is the main channel through which the pandemic crisis affected the activity of managing the reserves held by central banks. In the beginning of the pandemic, the yields of government securities issued by the states pursuing the activity of managing international reserves recorded sharp decreases along all maturity segments. Subsequently, yields for the short maturity segments remained low, while yields for the medium and long segments increased, leading to a sharp decline in government curves. According to the IMF forecast for October 2021, the trend of the global economy for the period 2021-2022 was that of a recovery, but under the spectrum of uncertainties regarding the evolution of the pandemic, the risks arising from supply channel blockages, inflationary pressures and their persistence, as well as the recovery policies adopted by international bodies and the conduct of central banks. For example, inflationary pressures in the euro area have been largely driven by rising energy prices and more recently manufacturing prices, generally due to temporary factors and base effects. The fact that price upward pressures are driven by rising costs, so cost push inflation, rather than rising demand, so demand-pulled inflation, favored central banks' rhetoric that these influences might be transitory. However, the persistence of these effects, although largely considered transitory, could delay the goal of returning inflation to target. In the process of transitioning from extremely expansionary policies started as a result of the pandemic to more restrictive monetary policies, central banks can implement two approaches with different impacts on the slopes of yield curves. On one hand, the increase in reference interest rates, followed by a stabilization of central banks' balance sheet, rather than a reduction in them, could lead to inverted yield curves, while earlier reductions in balance sheets, followed by reductions in reference interest rates, would lead to increases in the slope of government curves. The second approach would probably be preferred by central banks, as it would have the advantage of avoiding inversions of yield curves and would support a controlled increase in their slopes. An integrated and multilateral approach adopted by international financial institutions, governments, and central banks alike has been vital in mitigating the vulnerabilities posed by the outbreak of the pandemic. In March 2020, the European Central Bank launched a new temporary asset acquisition program designed to prevent the onset of a financial crisis following the outbreak of the pandemic. An initial amount of 750 billion euros has been allocated to the Pandemic Emergency Purchase Program, supplemented by a further 600 billion euros in June 2020 and a further 500 billion euros in December 2020. The PEP was thus a complementary measure to other acquisition programs and targeted long-term refinancing operations, with the main feature being its very flexible nature. The European Central Bank could acquire different types of assets on the financial markets in any moment deemed it necessary. At the monetary policy on 28 October 2021, the ECB decided to maintain monetary policy coordinates until December, when a major reconfiguration was expected. The outlook for the normalization of monetary policy, as well as the acceleration of the inflation rate in the euro area, led to widespread increases in euro area yields at the end of October 2020, especially for the medium and long-term maturity segments. Given the asymmetric nature of the shocks generated by the COVID-19 pandemic across countries and sectors, coordination between fiscal and economic policies became of utmost importance. Moreover, fiscal policy instruments are considered superior when a targeted approach of the most affected sectors is needed. From this point of view, the fiscal programs launched by the European Union in response to the outbreak of the pandemic have complemented monetary policy measures in reducing market fragmentation. The European Instrument for Temporary Support to Mitigate Unemployment Risks in an Emergency has focused on lending up to 100 billion euros by the European Commission to European Union member states, in which the pandemic has caused serious socio-economic consequences, in order to short-term financing of technical unemployment schemes and job protection. On the other hand, the Next Generation European Union programme throughout the Recovery and Resilience Mechanism is targeted at the longer term, mainly in the form of loans and grants to strengthen the economic recovery following the end of the pandemic, especially by financing public investment, in contrast to restrictive tax practices observed after 2009. As for the levels of issuance yields related to SURE and Next Generation European Union instruments, they remained above the yield on German government bonds at around 36 basis points during the period between January 2020 and October 2021. However, this spread could decrease in the context of increasing liquidity in the European Union bond market. The need for cohesion between monetary and fiscal measures was also recognized in the United States by the President of the Federal Reserve, Jerome Powell, who stated at the monetary policy meeting on 15 March 2020 that monetary policy has a role, but the fiscal response is critical. At the same meeting, the members of the Federal Market Operations Committee, or FOMC as they are known, decided to reduce the target range associated with the reference interest rate by 100 basis points to 0.25%, followed by another reduction of 50 basis points, which had taken place at the Emergency Monetary Policy meeting from the 3rd of March 2020. The measures adopted by Fed to mitigate the impact determined by the COVID-19 pandemic and to stimulate economic recovery have targeted both interest rate cuts and massive asset purchase programs. Thus, on 15 March 2020, The Fed announced that in the coming months it would acquire bonds issued by the U.S. Treasury worth at least $500 billion and mortgages worth $200 billion. 1 week later, the institution was already announcing that it will make purchases in the amount necessary to support the smooth functioning of the market and the efficient transmission of monetary policy. In April and May of the same year, amid improving market conditions, the Fed slowed down the asset acquisition progress, but resumed it in June 2020, when it announced that it would continue to acquire bonds issued by the Treasury until the next notification at a rate of at least $80 billion per month, and the purchase of mortgage bonds at a rate of at least $40 billion. Other measures taken by the Fed to ensure liquidity and maintain lending to the public and businesses following the outbreak of the pandemic have included extended the deadlines for repo operations, as well as increasing the amounts involved in these operations, the use of credit facilities for primary dealers, the money market mutual fund liquidity facility, or the facilities through which the U.S. Federal Reserve can lend to large corporations, both throughout the direct purchase of new corporate bonds issued, as well as by purchasing corporate bonds on the secondary market. The Fed has also opened foreign exchange swap lines with a number of central banks in order to provide temporary liquidity in US dollars. On 19 March 2020, Fed announced the opening of temporary US dollar swap lines valid for at least 6 months with central banks in Australia, Brazil, Denmark, Korea, Mexico, Norway, New Zealand, Singapore, and Sweden. The monetary programs launched by the Federal Reserve have been supplemented by unprecedented fiscal incentives of more than $2 trillion from Congress and the presidential administration in the form of business support and aid to the population. Of these, the approximately $2.3 trillion Coronavirus Aid Relief and Economic Security Act program under the Biden administration was the largest tax support program in the history of the United States. Monetary and fiscal stimulus has led, especially in the U.S., to an acceleration of the economic recovery from the COVID-19 crisis. The increasing yields in the medium and long term, approximately 40-50 basis points in the case of the U.S. government curve in 2021, was both a consequence of economic progress and the possible impact of increasing the current and anticipated supply of securities issued by the Treasury U.S. Investors' uncertainty about future economic policies and prospects could also justify the pressure to increase returns on the medium and long segments of the government curve. At its monetary policy meeting on 21-22 September 2021, Fed President Jerome Powell signaled the central bank's intention to start reducing the pace of assets purchases, tapering, while inflation and labor conditions are being met. At that time, the FOMC kept the monthly pace of asset purchases at $120 billion within the quantitative easing program, indicating that a reduction could begin soon, in a process of assets reduction that would be completed by mid-2022. At the same meeting from the end of September 2021, the FOMC kept the reference interest rate in the range of 0 to 0.25%, but 9 of the Fed officials, which is half of the committee, expected an increase in 2022 compared to 7 officials in June, when the projection of the median of the reference rate did not indicate any increase until 2023. Also, 70 members of the FOMC expected an increase in the monetary policy rate for 2023 compared to only 13 members in June. At its monetary policy meeting on 2 and 3 of November 2021, the Fed decided to reduce its tapering pace from 120 billion to 105 billion per month starting October, followed by another $15 billion cut in December. The decision was in line with the directions given at the monetary policy meeting from September, when the Fed President Jerome Powell signaled that the process of reducing the pace of assets purchase could start at any time. The Fed also kept the reference interest rate in the range between 0 to 0.25%, with Jerome Powell indicating that a discussion on raising the monetary policy rate would be premature as labor market data remain below maximum occupancy. In conclusion, given the asymmetric nature of the shocks generated by the COVID-19 pandemic across countries and sectors, coordination between fiscal and economic policies was of utmost importance. An integrated and multilateral approach adopted by international financial institutions, governments, and central banks alike has been vital in mitigating the vulnerabilities posed by the outbreak of the pandemic. In the period between 2020 and 2021, the global macroeconomic outlook was marked by the outbreak of the COVID-19 pandemic, which determined most central banks to adopt expansionary monetary policy measures of unprecedented scale. The divergence in access to vaccination among developed and emerging economies has segmented the recovery of the economy in two categories: one that followed a smoother path to normalization, as was the case in most developed countries, and the category of countries where recurrent reinfections and their complications prolonged an unfavorable economic climate. Changes in the psychology and consumption patterns induced by the health crisis, such as the increased interest in household goods and products and real estate, especially as a result of migration into the teleworking regime, have favored the emergence of temporary stock deficits, disruptions in chain logistics, and therefore disparities between supply and demand, which have resulted in higher prices. Inflationary pressures were believed to be transitory, so they have generally led to wait-and-see responses from central banks, which have maintained lax monetary policies aimed at stimulating economic recovery. Should price pressures prove persistent, central banks could accelerate the tightening of monetary policy. However, a premature transition to restrictive monetary measures would make the process of economic recovery more difficult. Thank you.